You have less than 18 months before what most people still call a theory becomes the unavoidable context of their daily life. I'm not talking about conspiracy. I'm not talking about doom. I'm talking about a documented, measurable, structurally confirmed shift in how money moves, how wealth is stored, and who controls it. And most people are going to feel it in their savings account before they ever understand what hit them. By the end of this video, you will have a 4-pillar capital blueprint that the top family offices in the world have used to preserve and grow wealth through every major financial reset of the last 200 years. Not theory, structural architecture. And it works at any level of capital, from $10,000 to $10 million. If your capital is sitting in a traditional savings account right now earning 0.5% while inflation quietly compounds against you, you are not being conservative, you are being used. Your money is the liquidity that makes the 1% richer. Your deposit fund their leverage. Your inertia is their profit. That's not an opinion, that's the mechanics of modern banking, and once you see it, you cannot unsee it. Here is what that actually means in real numbers. If you have $100,000 sitting in a savings account earning 0.5%, and inflation is running at 4%, which is a conservative estimate for the 2024 to 2026 period, you are losing $3,500 in purchasing power every single year. In 5 years, that $100,000 will buy what $83,000 buys today. Your statement will still say $102,500, but the grocery store, the utility company, the landlord, they will extract 17% more from you by the time this transition period closes. That is not a risk, that is a certainty, and it is built into the system deliberately, because governments that carry unsustainable debt need inflation to erode the real value of what they owe. Your savings account is the mechanism. You are the mechanism. This video is not a warning. Warnings are for people who are already too late. This is a blueprint, a 5-year capital positioning strategy built specifically for the 2026 to 2030 transition window. And if you stay with me, you will leave here with a structural understanding that most financial advisors will never give you, because most financial advisors are paid to keep you inside the system, not to help you architect your way around it. If you're watching this, you are already different from the majority. Most people absorb financial news passively and react to whatever the market does next. You are here because you want to design the outcome, not inherit one. That distinction is everything, and it has a name. We don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. Welcome to Wealth Forge. Let me tell you what the next 5 years actually look like from the outside, from the perspective of anyone who isn't emotionally attached to the old playbook. Right now, 3 things are happening simultaneously that have never happened together in the modern financial era. First, sovereign debt across the G7 nations is approaching levels that make traditional monetary policy nearly impossible to execute without consequence. The United States is carrying debt-to-GDP ratios that historically resolve in 2 ways, either through austerity that contracts the economy or through deliberate structured inflation that quietly erodes the real value of that debt. There is no third option. There is no magic number that makes it disappear. There is only the question of which mechanism they choose and which assets you hold when they pull the lever. And pulling the lever has a history. In the 1940s, the United States ran what economists now call financial repression. Interest rates were kept artificially low while inflation was allowed to run hot, and over a decade, the real value of wartime debt was cut nearly in half. Ordinary savers who held government bonds and bank deposits funded that deleveraging without ever being asked permission. In the 1970s, the same mechanism ran through a different transmission. Stagflation eroded middle-class purchasing power while real assets, specifically commodities and land, multiplied in value. The pattern is not new. What is new is the scale, the speed, and the global simultaneity of it. Every major developed economy is pulling the same lever at the same time, which means there is no traditional safe haven inside the system. The safe haven is the architecture outside it. Read that last sentence again. Which assets you hold when they pull the lever, because the lever is being calibrated right now, and most people are watching stock tickers instead. Second, the global reserve currency conversation is no longer academic, it's operational. The BRICS Plus bloc, which now includes nations that collectively represent over 40% of global GDP and more than 30% of global oil supply, is actively constructing settlement infrastructure that bypasses the dollar. This is not a future threat, it's a current infrastructure project. And here is what almost nobody is telling you. The institutions that manage old money, the sovereign wealth funds, the family offices in Geneva and Singapore, have already begun repositioning. They didn't wait for a news headline. They read the trajectory 3 years ago and moved quietly. The window to move with them rather than after them is the 18-month window I mentioned at the start. Whether it fully succeeds in the 2026 to 2030 transition window or takes longer doesn't actually matter for your capital strategy because the trajectory is established, the direction is set, and capital that is entirely denominated in dollar-based instruments held in dollar-based institutions managed by dollar-aligned advisors carries a directionality that most people haven't consciously chosen, they just inherited it. Third, private markets have structurally decoupled from public markets in a way that may be permanent. For decades, the logic was simple. Public markets were liquid, transparent, and accessible. Private markets were illiquid, opaque, and exclusive. But the calculus has shifted. Public markets are now increasingly dominated by automated trading systems, passive index flows, and institutional arbitrage that has little to do with the underlying value of the companies involved. Meanwhile, private markets, specifically private credit, infrastructure lending, and real asset ownership, are generating returns that public equities haven't consistently matched since the post-2008 QE boom. And the families who've known this for generations, they've been quietly doing it the whole time. So, that's the landscape, and now let's talk about what you actually do with it. The first structural move in the 2026 to 2030 blueprint is jurisdictional diversification, and I want you to understand what this actually means before you dismiss it as something only billionaires do. Jurisdictional diversification is not about running from your home country. It's not about tax evasion. It's not about hiding money in offshore accounts, which is both illegal and, frankly, an amateur strategy. What it is the deliberate spreading of your legal and financial exposure across multiple sovereign jurisdictions so that no single government's fiscal crisis, regulatory decision, or currency devaluation can eliminate your wealth in a single move.
The Rothschild family did this in the 1800s. They placed family members in capital simultaneously in London, Paris, Frankfurt, Naples, and Vienna. Not because they were running from anything, but because they understood that sovereign concentration is a structural vulnerability. They were right. Every one of those cities went through fiscal crises, wars, and currency collapses in the following 150 years. The family survived all of them because their architecture was broader than any single jurisdiction. And in 2026, with the same structural forces at work across a different map, the principle is identical. The only thing that has changed is the geography. Now, you don't need to do exactly what the Rothschilds did, but the principle scales to any level of wealth. The practical application for most of our architects in the 2026-2030 window looks like this. A second residency in a jurisdiction with territorial taxation, meaning they only tax income earned within their borders. A banking relationship in at least one institution outside your home country's deposit guarantee scheme, not because you distrust your home country's banks, but because you want optionality, and at least some portion of your liquid reserves in a currency that isn't directly correlated to your primary earning currency. Singapore, the UAE, and Portugal have been the top 3 destinations for this strategy among high net worth families in the last 5 years. Each offers different advantages. Singapore for banking infrastructure and political stability, UAE for zero personal income tax and regional connectivity, Portugal for EU access and a relatively affordable property entry point. But the specific destination matters less than the principle. You are building a structure that has more than one door. And I want to be specific about what more than one door looks like at the starting point, because the first move in jurisdictional diversification is not buying a villa in Lisbon. It is something far more accessible. It is opening a bank account in a foreign incorporated institution, not a foreign branch of your domestic bank, a genuinely foreign chartered institution. HSBC International, for example, allows residents of most countries to open a Singapore-based account online with no minimum balance requirement. Deutsche Bank's international division offers similar access across the EU zone. Standard Chartered operates an internationally structured account product that can hold multiple currencies simultaneously, which means you're not just getting a second jurisdiction, you're getting built-in currency diversification in the same account. None of these require you to travel. None require a lawyer. None require a significant capital commitment. What they require is the decision to start. And the decision to start is the entire difference between the people who navigate this transition as architects and the people who experience it as passengers. The second move is repositioning out of paper promises and into income-generating hard assets. And this is where most financial education completely fails people, because it conflates hard assets with speculation. Buying gold and waiting for it to go up is not a hard asset strategy. It's a macro bet dressed up in commodity language. A genuine hard asset strategy is about cash flow, assets that produce income regardless of what public markets are doing, regardless of what the Fed is saying, and regardless of whether the dollar strengthens or weakens this quarter. In the 2026-2030 window, 3 categories of income-generating hard assets stand out above everything else. The first is agricultural land, specifically productive farmland in regions with stable water rights and growing domestic food demand. This is not romantic farmland. This is industrial-scale food production land in regions like the American Midwest, Brazil's Cerrado, Eastern Europe, and Southeast Asia. Farmland has historically returned 10 to 12% annually on a blended cash yield plus appreciation basis, with almost zero correlation to public equity markets. Bill Gates is now the largest private farmland owner in the United States. That's not a coincidence. That's a thesis. And the thesis goes deeper than most people realize, because embedded inside farmland ownership is something that will become one of the most contested assets of the next 30 years. Water rights. In the American West, water is already trading as a commodity. In the Colorado River Basin, municipalities and agricultural districts are filing legal claims for allocation that will take decades to resolve. In Australia, water entitlements have their own exchange, their own pricing mechanism, and their own institutional investor class. The farmland that sits above a stable aquifer or that carries deeded surface water rights is not just a food production asset, it's a water asset. And water, unlike gold, unlike oil, unlike any other commodity, has no substitute. You can run an economy without crude oil. You cannot run an economy without water. The families who understood this 10 years ago bought quietly. The families who understand it now are still buying. That window is narrowing faster than most people in the financial media are prepared to say. The second is infrastructure debt, and this is one that most individual investors don't even know exists. Infrastructure lending is the private credit that funds the physical backbone of the world. The toll roads, the broadband networks, the water treatment facilities, the renewable energy plants. These loans are secured against assets that governments cannot allow to fail, which makes the default rates among the lowest of any asset class in private credit. Institutional investors, pension funds, sovereign wealth funds, insurance companies have been increasing their infrastructure debt allocations for 15 years. The reason you haven't heard about it is because there's been no mechanism for individual investors to access it below the institutional threshold. That access is now opening. The third category is data center and digital infrastructure real estate, and I want to separate this from speculative tech investing. Owning the physical infrastructure that houses compute, the buildings, the cooling systems, the fiber connections, is a different proposition than owning cloud software stocks. The demand for compute is structurally growing. Every major AI model, every enterprise cloud migration, every government digital system requires physical hardware in a physical building with physical power. Data center REITs and private data center funds give you exposure to that structural demand without requiring you to bet on which tech company wins the AI race. Now we are 2 moves into a 4-move blueprint. You have the jurisdictional layer and the asset layer. What you don't have yet is the income engine,
the mechanism that generates cash flow every single month regardless of what markets do. That is move 3, and it is one that separates the people who understand this architecture from the people who simply admire it. The third move in the blueprint is building private credit ladders, and this is the strategy that the very wealthy have used for decades to generate income that doesn't show up in public market volatility.
Private credit is simply lending, but outside the traditional banking system. When a mid-market company needs growth capital, they don't always go to a bank. Banks have regulatory constraints, capital requirements, and approval processes that make them slow and restrictive. Instead, they go to private credit funds, which can move faster, structure more creatively, and charge higher rates in exchange for that flexibility. The typical private credit loan in today's market carries an interest rate between 10 and 14%, significantly higher than you'll find on any public bond, and floating in nature, which means it adjusts upward as rates stay elevated. Now, the way individual investors access this is through private credit funds, and the most sophisticated approach is building a ladder across 3 time horizons. Short duration credit, typically 12 to 36 months, gives you liquidity and capital recycling. Medium duration credit, in the 3 to 7 year range, gives you yield optimization and compounding. Long duration infrastructure credit, 10 years and beyond, gives you the highest rates and the most predictable cash flow. When you hold all 3 simultaneously, you create a rolling income machine that matures and reinvests at different intervals, constantly generating income regardless of what equity markets are doing. The key qualifier here is credit quality. Private credit is not all equal. The top quartile of private credit managers has historically produced returns that rival or exceed private equity, with significantly lower volatility. The bottom quartile has produced defaults and capital impairment. The differentiator is underwriting discipline, how carefully the manager evaluates borrower quality before writing the check. This is not a market you enter through a random ETF. It requires due diligence on the manager, the portfolio construction, and the vintage year. So what does that due diligence actually look like? There are 3 questions every architect should ask before committing capital to any private credit fund. First, what is the manager's default rate over the last full credit cycle, including 2020 and 2022? Those were the stress tests. Anyone could look good in 2021. The managers who preserved capital through the stress years are the ones worth examining closely. Second, what is the loan-to-value ratio across the portfolio? Conservative private credit managers typically lend at 50 to 65% of the asset value, which means even in a default scenario, there is collateral recovery. Aggressive managers pushing 80 to 90% LTV are chasing yield at the expense of structural protection. Third, what is the fund's liquidity structure? Some private credit funds offer quarterly redemption windows. Others are fully locked for 5 to 7 years. Neither is inherently wrong, but the mismatch between your own liquidity needs and the fund structure is one of the most common and most expensive mistakes individual investors make in this asset class. Know your horizon before you commit the capital. I want to stop here for a moment and address the question I know is forming in your mind, because it forms in every conversation I have about this. Dr. Ben, this sounds like it's only for people who are already wealthy, and I understand why it feels that way, but I want to challenge that assumption directly. The strategies I've described today, jurisdictional diversification, income-generating hard assets, private credit laddering, exist at every scale. The Rothschild family did them with billions. Family offices do them with tens of millions. But the structural logic is identical whether you're starting with $50,000 or $50 million. You don't need to buy a farm in Brazil. You can access agricultural land through fractional ownership platforms that start at $10,000 minimums. You don't need to start a private credit fund. You can access private credit through interval funds that open at $25,000. You don't need dual citizenship today. You can start with a second bank account in a foreign institution, which many of the major international banks allow with a $1,000 minimum deposit. The structure is scalable. What changes with scale is the access, the negotiating leverage, and the speed of execution. And the only way to close that gap is to start building the structure before you need it. Because when you need it, when the economic shift becomes visible to everyone, the entry points narrow dramatically. Here is something I want you to sit with for a moment. The fact that you are watching a video about private credit ladders and jurisdictional diversification on a Tuesday afternoon, or whenever you're watching this, means you are already in the top fraction of financially aware people on this planet. Not by income, not by net worth, by the quality of the questions you are asking. And that is the real compounding advantage, because the questions you ask today determine the architecture you build tomorrow, and the architecture you build tomorrow determines which side of this transition you end up on. The fourth move is almost no one in mainstream financial media talks about, and that is human capital diversification, the deliberate development of income streams, skills, and professional networks that transcend any single national economy. And I want you to notice something. This move is the one that makes the other three permanent. Jurisdictional diversification gives you optionality. Hard assets give you cash flow. Private credit gives you yield. But none of those structures survive long-term without a human being at the center who cannot be confined to a single economic zone. Here is the reality of 2026 to 2030 window. The global labor market is being restructured by AI at the same time that global capital flows are being restructured by geopolitics. The people who will navigate this most successfully are not those who have the best job in their local economy. They are those who have built economic relevance that can operate across multiple economies simultaneously. This means different things for different people. For some, it means building a professional reputation in a globally portable skill set, finance, engineering, medicine, law. For others, it means building a business that generates revenue in multiple currencies from clients in multiple countries. For others, it means investing in relationships and networks in economies that are growing faster than their home economy, Southeast Asia, the Gulf, East Africa. Let me make that last one concrete because it's the one most people underestimate. Southeast Asia, specifically Vietnam, Indonesia, and the Philippines, is projected to add the equivalent of a new Germany to global GDP over the next 15 years. The middle class in these countries is not just growing in size, it is growing in sophistication, in purchasing power, and in its demand for professional services, financial products, and technology. The professional who has built a consulting relationship, a client base, or a business footprint in that region before 2028 will have access to a growth engine that their purely domestic peers simply do not have.
The Gulf is a different story. It is the intersection of sovereign capital, energy transition investment, and a deliberate government-driven effort to become the world's new financial crossroads. Abu Dhabi alone has deployed more capital into global private markets in the last 5 years than most European sovereign wealth funds have in the last 20. Being positioned professionally in that ecosystem, even one relationship deep, is a different kind of optionality. It is not about chasing the next market. It is about being present in the rooms where capital decisions are made before those decisions become headlines. The point is not to abandon where you are. The point is to expand the surface area of your economic participation so that no single government policy, no single industry disruption, and no single currency can clip your economic wings in one move. This is what family offices have always understood and what mainstream financial advice has never adequately addressed. Wealth is not just a balance sheet. Wealth is a multidimensional structure, legal, geographic, relational, and professional, that is designed to survive shocks that a single-dimension strategy cannot. Let me bring this home. We are standing at the beginning of a 5-year window that is genuinely unlike any that has come before in the modern era. Not because catastrophe is inevitable, it may not be, but because the architecture of the global financial system is undergoing a structural redesign that will redistribute trillions of dollars of wealth from those who are positioned inside the old structure to those who have built a new one. The old structure is savings account, equity index funds, single country, single currency, single income stream. It served people well for 50 years. It will not serve you well for the next 5. The new structure is multi-jurisdictional legal architecture, income-generating real assets that produce cash flow regardless of market conditions, private credit that gives you bank-like returns without bank-like constraints, and human capital that is globally portable and geographically diversified.
Think about what you now know that you didn't know 20 minutes ago. You know that the BRICS Plus settlement infrastructure is operational, not theoretical. You know that farmland returns 10 to 12% annually with near zero market correlation. You know that private credit pays 10 to 14% and that you can access it with $25,000. You know that the Rothschild architecture, the one that survived every financial collapse of the last 200 years, is structurally replicable at your level of capital. That is not a small thing. That is a recalibration of your financial worldview, and it happened in the time it takes most people to scroll through their social media feed. But here is the part that most financial content will never tell you, because most financial content is designed to make you feel informed without making you feel capable. Feeling informed is passive. Feeling capable is dangerous to the system that needs you to stay inside it. What you have right now is not just information. You have a sequence. You have an order of operations. Jurisdictional architecture first, because it is the legal container that makes everything else structurally defensible. Hard assets second, because they provide the cash flow base that removes your dependence on market performance. Private credit third, because it generates the compounding yield that accelerates the architecture. Human capital fourth, because it is the engine that produces everything else and the only part of the structure that cannot be inflated away, taxed away, or seized by a government that needs liquidity. 4 moves, a specific sequence, and each one builds on the last. That is what a blueprint looks like. That is what being an architect means. This is not radical, this is not exotic, and this is not reserved for people who attended private schools and inherited a Rolodex of private bankers. This is what the wealthiest families in the world have done for generations. The only thing that has changed is that the tools to access this structure are now available to people who aren't in the top 10%. The platforms exist, the minimum thresholds are declining, the education is available, though you have to seek it out, because the mainstream financial industry has no incentive to give it to you. You are here. You are seeking it out. That already puts you in a different category from the vast majority of people who will feel this transition before they understand it. So here's what I want you to do before this video ends. Write down the 4 pillars we covered today: jurisdictional diversification, income-generating hard assets, private credit laddering, human capital diversification. Not because you're going to execute all 4 simultaneously tomorrow, but because you need to know which one is the most urgent gap in your current architecture. For most people watching this, it's either Pillar 1 or Pillar 3. Most people have 0 jurisdictional diversification and 0 exposure to private credit. Those are the 2 moves that historically do the most structural work in the early stages of a transition period. And if you want a more specific starting point than that, here is a 30-day first move for each pillar. For jurisdictional diversification, in the next 30 days, 1 internationally chartered bank account. Research the options I mentioned: HSBC International, Standard Chartered, and Deutsche Bank International, and choose the one that matches your residency requirements and currency needs. Deposit a small amount, even $500. The goal is not the balance. The goal is the structure. For hard assets, in the next 30 days, research 1 fractional farmland platform. AcreTrader and Farm Together are the 2 most established in the United States, and complete their investor qualification process. You're not committing capital yet. You are building the knowledge base that lets you move with confidence when you are ready. For private credit, in the next 30 days, identify 2 or 3 interval fund managers with 5+ year track records in direct lending. Read their most recent quarterly letter. Understand how they describe their underwriting process. Ask yourself if their logic is conservative or aggressive. That distinction will tell you more about their risk posture than any marketing deck they send you. For human capital, in the next 30 days, identify 1 professional relationship in a non-domestic economy that you could deepen, not a new connection, an existing one that you have let go quiet. Send 1 message. That is the entire action, because the architecture of human capital is not built in a single move. It is built in the accumulated weight of small, deliberate gestures toward a broader world. Over the next several videos, we're going to go deep on each of these pillars: specific structures, specific platforms, specific frameworks for implementation at every level of capital. We're going to talk about private family banking, which is one of the most underutilized tools available to anyone building a serious wealth architecture. And we're going to cover how to set up your first international banking relationship without flying anywhere, without a minimum deposit above $5,000, and without a lawyer on retainer.
This channel is not about getting rich. It is about building a structure that keeps you rich and gets you there even if the market doesn't cooperate. That is the architect's approach. That is the Wealth Forge approach. If that resonates with you, subscribe, not as a passive gesture, but because every video I release is going to add another structural layer to this blueprint, and the architects who are building alongside this channel will be 3 to 5 moves ahead of everyone else by the time 2028 arrives. And before you go, I want you to drop one answer in the comments, not a question, an answer. Tell me, which of the 4 pillars is your biggest gap right now? Jurisdictional diversification, hard assets, private credit, or human capital? Read through what other architects are saying, because the most common answer in this community is the topic of the next video. Your comment is not just engagement, it is the editorial direction of this channel. That is how we build this together. We don't follow the market, we design the moat. I'll see you in the next one.